Technical indicators are the most important tools that effectively analyze the charts to get an idea about the future stock prices. These indicators are heuristic and pattern-based techniques widely used by the technicians to predict the trends in future price movements. Technical indicators resort to mathematical calculations based on price and volume of stocks traded in the market. These indicators are also known as technicals commonly used by the active traders. As a definition, we can say that a technical indicator is a series of data points that are derived by applying a formula to the price data of a security. The price data here refers to any combination of the open, high, low, or close prices over a period of time. Some indicators may take only the closing prices, whereas some use volume of the stock traded over a period of time. For calculating the indicators, a technical indicator is a series of data points that are derived by applying a formula to the price data of a security. The price data refers to any combination of the open, high, low, or close prices over a period of time. Some indicators may take only the closing prices, whereas some indicators use volume of the stock traded over a period of time or open prices in their calculations. The price data is entered into the formula and a data point is produced. For example, the average of 5 closing prices is one data point. For example, closing prices of 5 periods or 5 days, that is 40, 45, 50, 55 and 60 may be taken, and average for these data can be taken. So the average here is the closing prices of these 5 days divided by 5. So we get the total, we have to divide the total of these closing prices of these 5 days by 5 and we get 50. So here the data point is 50. But one data point does not offer much information and does not give valuable inputs for trading decisions. A series of data points over a period of time is essential to make a detailed analysis of the market. A time series of data points enable the users to make a comparison between past and present data of price movements. Generally, technical indicators are represented in graphical forms above or below the price charts of a stock. The geographically represented indicator helps the traders to draw relevant trend information by comparing the price chart of a stock with its corresponding chart. Now we can see the different functions or the core functions of technical indicators. Basically, indicators perform three major roles or three important functions. These functions are alert function, confirmation function, and prediction function. Indicators perform an alert role or the function in the market that induces the traders and market participants to study the price movements in detail. For example, if the momentum or velocity of price changes of stock is high, then it gives a warning signal of a break of support or resistance. Indicators give confirmation signal regarding the price movements in the market. So it gives confirmation regarding whether a trend is being established or there is a reversal trend. So a confirmation signal is also a major function of a technical indicator. Above all, indicators give valuable inputs for the prediction of future price movements and trends in the market. Technical indicators are basically classified under two heads such as leading indicators and lagging indicators. The various indicators used in technical analysis are either come under the category of leading indicators or lagging indicators. A leading indicator is a tool designed to foresee the future direction of a market and enable traders to predict market movements ahead of time. A leading indicator gives a signal before the new trend or reversal occurs. Leading indicators aim to signal trend changes before they develop. Lagging indicators alert traders about the beginning of a trend and give signals to them to pay attention to the changes occurred in the existing trend. Lagging indicators inform changes after the occurrence of changes in the trend or price movements. On the basis of the focus or purpose of indicators, technical indicators can be classified as trend indicators, momentum indicators, volume indicators, and volatility indicators. In the case of trend indicators, they show the direction of the market moving in. Momentum indicators divulge the strength of a trend in the market. Volume indicators hint how the volume of stock traded over a period of time. This is useful because when the price changes, the volume gives an indication of how strong the move is. Volatility indicators tell how much the price is changing over a period of time. Now we have to see some of the widely used common indicators in the market. Now we can see some of the popular indicators used by the technicians in the stock market. One is moving average. It is the arithmetic mean of a given set of closing prices of a stock over the specific number of days in the past, such as calculation of the simple average of the past 5 days, 10 days, 30 days, or 100 days. The average is updated by avoiding the old data and adding the recent data. This facilitates the average to proceed with the timeline and improves its reliability while defining the trend and price direction. Now, another important indicator used by technicians in the stock market is exponential moving average, or simply EMA. The EMA is a weighted moving average that gives more weightage or importance to the recent price data. It is an advanced version of the simple average that puts greater weight on the most recent data points while calculating the average of a particular day. The EMA does not give same importance to the old and recent data points as in the case of simple moving average. It assigns more weight to recent data than old with the help of an exponent, which gives more power to the recent data on the basis of its importance. A trader can customize the weight or the weightage or the exponent in the indicator on the basis of the importance and recency of the data. Then another important indicator used by technicians is moving average convergence divergence, or MACD. It is a trend and momentum indicator based on the relationship between the two exponential moving averages of a stock price. It is computed by subtracting 26 period exponential moving average of the prices of a stock from the 12 period exponential moving average. The MACD line is constructed by plotting the results so arrived. Afterwards, a 9-day EMA of the MACD will be computed, which is known as the signal line. When the MACD line moves up and crosses over the signal line, there is a bull trend and upward momentum in the stock price. This is called a positive crossover and an indication to buy shares. This occurs when the 12 period EMA is more than the 26 period EMA. On the contrary, if the MACD line comes down and crosses over the signal line, there is a bearish trend and downside momentum occurred in the stock price. This is called negative crossover and gives an indication to sell the stock. This occurs when the 12 period EMA is lower than the 25 period EMA. There is a central line on the MACD which shows the histogram based on the results of the MACD minus the signal line. If the MACD is above the zero line or the central line, the trend is bullish, and if it is below the zero line, the trend is bearish. Now, another important indicator is Relative Strength Index, or RSI. The Relative Strength Index is a momentum indicator commonly used by the traders to understand whether a stock is overbought or oversold. The index measures the velocity or pace or the magnitude of price movements of a security. RSI compares the magnitude of average gains and average losses of a security for drawing inferences about its strength and weaknesses over a predetermined time period. The RSI is an oscillator because its values are fixed between 0 and 100. If the RSI is below 30, it signals an oversold position in the market. And if it is above 70, it shows an overbought position. RSI is equal to 100 minus 100 divided by 1 plus RS. Whereas RS is equal to average closes up in n periods divided by average closes down in n periods. Another indicator is stochastic oscillator. It is a momentum indicator that compares the particular closing price of a stock with high and low ranges of closing prices of that stock over a period of time. Usually, the period is 14 days. The values of this oscillator are between 0 and 100. Values below 20 indicates an oversold position and above 80 show an overbought position. So these are some of the important indicators used by technicians to gather information about the market or price movements. There are numerous indicators used by the technicians. These are only a few indicators, and these are the most common indicators used by the technicians in the stock market to predict price movements or to get an information about the nature of trend in the market. Thus, with the help of indicators, traders and investors can predict the time to enter and exit the market, thereby enabling good returns. These are the most significant and widely applied tools in technical analysis to extract crucial information about market direction, trends, and price movements.